David Tepper was on Squawk Box this morning and laid it out pretty clearly. Take a listen.
Don't love the multiples, but how do I not own it with an easy, I'm not ever fighting this Fed, especially when the market's telling me I don't know what it is today, but 1 3/4 more cuts, before the end of the year. So that's a tough thing not to own.
Josh, that pretty much says it all. I'm not ever fighting this Fed, as he has really maintained from the depths of the financial crisis. When the Fed gets involved, you just don't fight it.
Well, I think the old playbook works just as well as any new playbook that anyone can come up with. And I think market participants have been sniffing this out for months. Small caps and financials. You can do other things, and we can get more specific, looking at home builders, et cetera. But small caps and financials are really the playbook. And that trade is en fuego already. Right at all-time highs today on the Russell 2000. If the Russell 2000 closes today at an all-time high, which is possible, I'll let you know in 4 hours if it happens, this would be the first all-time high close since November 8th, 2021. That's 967 consecutive days without an all-time high in the Russell 2000. That's the second longest streak in the history of the stock market. So we talk about big bases and breakouts and consolidation periods that are resolving to the upside. This is like the mother of all consolidation periods for the Russell 2000 segment of the market. We also have 36 financials on our best stocks in the market list. We talked about a bunch of them the other day. JP Morgan, MasterCard, Bank of America, Wells Fargo, BlackRock. You want to be long a market where those 5 names are among the top performing stocks. Then you look at small cap financials, which scratches both itches at the same time, right? So you've got Interactive Brokers, which we talked about, Synchrony, we talked about, Huntington Bank. I did 10 minutes on HBAN the other day here on the show. Look at the way these stocks are trading. Huntington Bank is 4% above its 50, 10% above its 200. There's no resistance above. Stock is only up 9% year to date. You didn't miss anything. There's been no multiple expansion for the financials. None. You're not paying up for these stocks. The financial sector is selling at the same PE multiple it was selling at in January. So what's the playbook? What do? This is the thing that always works. It doesn't require the Fed going down to 2% Fed funds rate. If the Fed is on your side, small caps should work. Financials will almost definitely.
So, Joe, is it that simple as David Tepper lays it out? I mean, he's always had this amazing ability to just distill it down to the most easy to understand things that are going to drive the markets. I'm not ever fighting this Fed.
No, you're not going to fight the Fed, and I think you also don't want to fight the calendar. I do think we set up here for a possible chase for performance. And to Josh's point, there's also the conversation about pivoting in a different direction where there has been some form of relative underperformance. Josh is talking about the financial sector. Look, the reality is, and in this business, you have to take satisfaction as an investor when you're investing in a particular direction and you get rewarded for it. I'm very proud. I'm very satisfied of what Joe T has represented. It took a overweight position in financials in January of 2024. We're at 35% right now. So, Scott, yesterday on the dip, I'm sitting there thinking exactly what Josh is saying. This is a moment where you don't want to fight the Fed. You don't want to fight the calendar. You're going into a rate cutting cycle. You see that small caps are rallying. You see that financials are rallying. What do I want to do? Do I want to find a single financial? And I basically just bought more Joe T because we own 44 names. We own all the regional banks that Josh is talking about. We own the money center banks. And I think collectively the sector benefits from not just that, but also investor engagement, an increase in M&A, and regulatory relief. So front and center, to me, that's where the financial sector is right now. And I think it's represented in the price action. And clearly you don't want to fight that.
Malcolm, it's financials with a record today, as we've said. Citi is a 52-week high, Goldman record, Morgan Stanley record, B of A 52-week high, JP Morgan record high. Mike Mayo talking about it, of course, from Wells Fargo Securities today. You get rate cuts, you get no recession, you're going to get a continued rally in bank stocks. It's the housing trade, as Josh was mentioning. You've got price targets going up almost across the board from some firms because of the rate cut. You have the gold move, you got the small caps move. But let's start with the financials. What does your exposure look like here?
Yeah, Scott, I hear everything that Joe T is saying. I hear everything, the case that Josh laid out for the small caps, which tend to lean financials more than anything else, and the rate cutting cycle being the perfect time to be owning these. But I would argue a little bit differently that as a person who looks downside first anytime it's time to make a new investment, I don't necessarily want to be owning the banks that are below the big six. And realistically, I think the big three, JP Morgan, Goldman, and Morgan Stanley, are where I would cut it, simply because the banking sector itself has ceded a lot of ground over the last decade to the private credit market that's taken over the commercial lending space, which tends to be the biggest piece of that business, which is very sensitive to net interest margin. That is the metric that really matters as a shareholder when quarterly reports come out. And that metric doesn't so much matter anymore for the likes of the big three that I just named, who make the lion's share of their revenues from deal premiums that come on the backs of M&A transactions, wealth management, those sorts of things. And so as an investor, I hear you. I really love the momentum behind the financial sector as a whole right now. But just thinking about us potentially being at all-time highs in the market and everything else that we've been discussing, I would much rather own the safety of a well-diversified financial than having to worry about one that's very sensitive to interest rate moves.
I'm surprised you don't own any of the major banks. That just feels like a miss. However, you nuance it. No JP Morgan, no Goldman Sachs, no Morgan Stanley, no Bank of America. Why not?
Yeah, so we do own it in our growth and income portfolio for a number of clients, all three of those names you just mentioned. I personally prefer the fintech space because I think there's a tremendous amount of upside. If you look at the name like a SoFi, for example, which I do own personally, their core competency to me is buried underneath the surface, which is their ability to offer banking as a service technology to other banks that don't want to have to go out and get their own bank charter to offer banking solutions. So that tends to have a much bigger upside potential and is not so interest rate sensitive to me versus something like a traditional financial like we just described.
Jenny, your favorite name, your only name is Columbia Banking. Why?
Well, okay, so if you're picking out that specifically, Columbia is in the dividend income strategy. And
well, I'm picking it out specifically because I have it as the only one you own.
Okay, but if we were to spread
what do you want me to do?
Say like, all right. Well, because you can't say, Jenny, why don't you own financials, right? You should own the large cap financials. They don't have the dividend yield. They don't have the free cash flow yields for me to own them. So I have to say, where can I find yield? And I think there's upside too. So I've owned Columbia for several years, and it's been a great performer. Not this year. This year it's mediocre at best. Once you put the dividend yield in, it's a little bit better. But we take a broader lens. And so we also own Schwab, which is up 26% this year. We own American Express, which has been a great performer. The big banks just don't fit our strategies. They don't have the free cash flow yields that we need.